Good morning and welcome to episode 82 of Getting Rich. I'm your host, Rich Checkan, president of Asset Strategies International, and today is Wednesday, July 20th, 2022. I just returned from spending a week in Las Vegas at the 2022 Freedom Fest conference, me and about 2,100 others, and as expected, the big question on everyone's mind was, why isn't gold doing its job? Now, those of you who have listened to me over the weeks and months past know that I firmly believe gold is doing its job. I know it has fallen about 6-7% thus far in 2022, but in a deflationary environment, and I know people are going to say, wait a second, Rich, it's an inflationary environment. Well, we're seeing signs of inflation, but as the Fed tightens and lets the air out of the everything bubble that they created, we are seeing asset prices deflate. So we're seeing a pullback in the stock market, we're seeing a pullback in Bitcoin, we're seeing a pullback in gold. But here's the thing about gold. In a deflationary environment, it outperforms other asset classes by falling at a much slower pace than the rest. So gold is in fact doing its job in the current deflationary environment. It is getting ready to soar in the inflationary environment, in what I believe a stagflationary environment that will follow. Let's take a look at the numbers over the past week. This week, gold is down about 1%, just under 1%, to 1,714.10 an ounce from 1,730.50 last week. Silver's down about 0.5% to $18.94 from $19.05. Platinum is up 4.33%, the big winner this week, at $892 an ounce from $855 last week. Palladium, big loser this week, down 7.9% after several weeks of climbing. It's down to 1,936 an ounce from 2,101. With silver falling at a slower pace from gold, the number of ounces of silver it takes to buy that ounce of gold has dropped, so the gold-silver ratio is down to 90.93 this week from 91.27, and the dollar is also down a little bit, hitting that peak last week. Last week it was 107.98 for the broadcast, but it got as high as 109. It's down to 106.58 this week. Now, all eyes this week and next week are focused on the Federal Open Market Committee. Next week, they will come out with their newest rate decision. It was a foregone conclusion 2 weeks ago that they would raise rates 75 basis points. Now, a lot of people think they will actually raise it to 1% or 100 basis points, just because we had, again, horrible PPI and CPI numbers, both higher than expected and both showing that we had not yet peaked, that we were peaking even higher. Now people are saying, this is it, we're done, we've hit the peak, we'll see what happens next month. But in June, we saw higher yet inflationary numbers. I look forward to what we're going to see, which is more of a stagflationary environment. I do believe that the Fed has another 1, 2, or 3 rate hikes in them, but there is only so far they can go. We have $30 trillion in debt. Every 1% increase in interest rates by the Fed means another $27 million per day to service the debt on $30 trillion. $27 million a day to service the debt on $30 trillion with every 1% increase in interest rates. There's only so far they can go and no further. They will reverse course. We will see a weak economy with high inflation, and folks, when that happens, gold will shine. It's on sale right now. Take advantage of it. It won't last. As always, like you to go ahead and subscribe and like us to YouTube. Follow us on social media. By all means, take our free newsletters. We put a lot of effort into them, and we want to share our thoughts and experience with you. And whatever you do, don't ever forget that getting rich starts with keeping what's yours.